Okay, Tom Lee has given us an urgent warning for the stock market. Strap in, sit tight. We're going to listen to Tom Lee and explain everything that's going on. First, Tom Lee explains what he thinks is going to happen in the market, which sectors that you're going to have to invest in, what his concerns are, and I am going to give you the top stocks to invest into right now during this specific time in the stock market. However, first, I have a huge announcement. This Monday, September 23rd, 8 p.m. Eastern Time, 5 p.m. Pacific, my masterclass webinar, free masterclass webinar. If you guys missed it the last time, it is coming up on this Monday night. Do not miss it. The link is in the information box below to register. There are very limited spots left, so if you miss out, there will be no chance at attending this webinar. Like I said, spots are limited. You will learn more in this 1 hour with me than you will anywhere else. I have a huge announcement during the webinar, and there'll be a Q&A where you can ask me any questions that you may have about your portfolio or the stock market. I hope to see you guys there. So let's touch base on Tom Lee. He gives his prediction and his warning on the market. Let's take a listen to what he has to say, and then we'll come back and I'll explain to you guys what he's talking about and go over some of the data with you.
Too many that were in the camp of a hard landing coming, or the Fed would be too late. And this Fed cut cycle, I think, is setting the stage for markets to be really strong. What the stocks do between now and, let's say, the election day, I think is still a lot of uncertainty. And that's the reason why I'm a little hesitant for investors to dive in. But if I was going to advise where to be positioned, Carl, it's exactly what you said. It's cyclicals, which is industrials, financials, and small caps. Tech and Mag 7 still keeps up with the market. And that's why if someone owns it and they have tax implications, I wouldn't sell it. But for all these folks that have been sitting on defensive positions or thinking the Fed cut was going to be too late and the market was going to, equity markets were going to fall, I think those folks have to allocate into cyclical stocks, especially small caps, because they are not only sensitive to the cut in rates because of variable rate debt, but they're going to benefit from the cyclical boost to the economy as mortgages. The cost of mortgages drop, auto loans, credit cards, the lift to the consumer, potential M&A, all these are big tailwinds for small caps. But I think one thing investors have to distinguish is that real growth, like GDP growth, doesn't mean inflation pressures, because inflation is, a mismatch of supply and demand. And I think there is a lot of excess supply potentially coming. For instance, housing could have a supply response. And if you look at the two biggest drivers for inflation for the past 8 quarters, it's been shelter and rent rolls and auto insurance. And auto insurance, I think these insurers have reached sufficiency, so you're not seeing the premium increases anymore. So unless the rest of the CPI basket accelerates, inflation is actually falling pretty sharply. The one thing that I think we have to keep in the back of our minds is that CEOs have been cautious for the last 2.5 years because the Fed telegraphed a tightening cycle to fight inflation. So I think that the fact that rates and now we're in an easing cycle means that companies are going to actually start doing expansion. So I think the labor market and the Fed is mentally knocking down these monthly numbers. I think tailwinds are emerging for labor markets to actually strengthen.
So we heard what Tom Lee had to say. We're going to break this down piece by piece, section by section. We know that the stock market doesn't like uncertainty. It doesn't like uncertain situations, and that's what creates volatility. With the elections coming up, that's an uncertainty. We don't even know who's going to be in the White House at this point in time, and the stock market does not like that. Investors do not like it. So that is a very big issue right now that's causing bumpiness in the road ahead. But it's not just that. You see, the stock market, investors, the market as a whole, as an entirety, wasn't expecting a 0.5 or a 50 basis point rate cut. It hadn't priced that in. It was pricing in a 25 basis point cut. So when 50 basis points were cut, the stock market rallied. And after the rally, and it priced all of that in, the uncertainty of the elections and the possibilities of maybe a recession and other things going on has caused the market to pull back. Tech stocks are okay right now, like AI, like NVIDIA, AMD, Tesla. You can hold on to them. They will grow, but they're going to probably grow a little bit slower until we get to November and go over that speed bump we call the election. In the meantime, what Tom Lee was actually saying is that the best sectors to invest into are cyclical stocks like financials, small cap, and industrial. And that's what I've been telling you guys. SoFi, Wayfair, Walmart, Amazon, Target, TJ Maxx. These are good retail stocks. Alibaba. These are just a few. The other sectors, one being industrial, we could look at Colgate-Palmolive, Johnson & Johnson. There's a couple other stocks that I wouldn't mind adding into there, like Kraft and Heinz and Coca-Cola. And then we move over small cap stocks, because small cap stocks are going to be faster growing due to interest rate cuts because of lower interest rates. So these are the sectors that you really want to look into. And that's what Tom Lee said. The market's long-term signals are bullish. Look, inflation is over. That's what Tom Lee also explained. And this is a point that I want to explain, is that right now PMI data is out. Services are up pretty good. Manufacturing is down slightly, but still pretty decent. And when we look at other data like consumer spending and CPI, it's pretty decent, slightly improved or neutral, still very good. When we look at those datas and then we look at the rate cuts and inflation falling from 3.2 to 2.9, now to 2.5%, everything's looking good. Inflation is falling like a rock, just like Tom Lee said. It really is dropping pretty quickly and sharply. But two of the datas that are kind of skewing all of this are auto insurance and shelter. You see, they only update auto insurance and shelter like once a year, sometimes once every 2 years, like whatever it is. It's very, very far and few between in updates versus PMI data, which comes out every single month, twice, actually more than twice, but we're just talking about services and of course, manufacturing. Those are the two that come out every month that I always track. So you figure 12 times a year for each of those, 24 in total versus once. And the thing is that people don't really buy a new home every year or every 6 months, and they don't update their auto insurance every 6 months or every year. So this data is kind of skewing the perspective and the financials and the analytics of the market. The data is kind of skewed because of this. So it's kind of dragging inflation along for the ride, and we're kind of stuck in this weird sentiment that there's inflation. Well, the thing about rate cuts, when they cut the rates proactively in a good economy like we have now, there could be a slight pullback or overreaction in the short term. But in the long term, markets are usually up historically based on data 10 to 15%. Now, when the Feds cut rates reactively in a bad market short term, there could be a 10 to 15% pullback or even more. But in the long term, 1 year or more, historically based on facts during these times of rate cuts that were reactionary, the market's pullback over the course of a year or more is 1 to 2%. So you can see that it really doesn't matter if you're a long-term investor. If the rates get cut and they're doing a bad job in a year or a year and a half from now, it's going to be practically break even. If they're doing a good job, we'll be 10 to 15% up than when we were. And if they do a good job, it'll be a 10 to 15% growth. So as a long-term investor, we're either going to be neutral or have growth, but it doesn't really affect us if we're long-term. A year to a year and a half, historically, even after bad rate cuts, is almost completely neutral at zero, like -1% to -2%. So with this being said, even a bad rate cut, a reactionary one, is going to affect day traders, scalpers, and bi-weekly swing traders the most. If you're like a 6 months to a year investor or even longer, it's going to have a lot less effect on you. Like I've been explaining to you guys in the past, over and over again, I sound like a broken record. If you buy a stock at 20 and it drops to 1 and it jumps to 100, drops to 1 and goes up to 25 and you sell in a year, does it really matter what happened in between? You got in at 20, you got out at 25. Everything in between is noise. The interest rate cuts, inflation, the threats and the scares of a recession, the election, all of this is noise. It doesn't matter, because if you're a long-term investor, 1 year, 2 year, 3 year or more, it doesn't matter what's happening in between. If you buy Tesla right now for $235 or $240, it doesn't matter what happens over the next 6 months to a year. In 5 years, the stock's probably going to be $350 or $400. Everything in between is noise. And this is what I've been trying to explain to you guys. We also have oil, $70 a barrel. This is not inflation territory for crude oil. Another thing we have to touch base on is employment. Unemployment is dropping and jobs are being added, and it's going to actually start to grow exponentially and create a snowball effect. And the reason this happens is because right now we're not having a lot of employment because businesses were waiting on rate cuts. The interest rates were high. Money was more expensive to get. Therefore, they weren't hiring. They weren't advertising or looking for new hire. So there was jobs that were not being had or not available, which means the job market was suffering. But now that the rates are getting cut, money will be cheaper to acquire, which means businesses will start being more bullish, more dovish. They'll be looking to hire people. And when you hire people, more individuals have jobs. Unemployment rate starts to go down. More jobs means more money, more spending. Money's easier to acquire. And therefore, exponentially over the course of 6 months to a year or longer, the economy fixes itself. It's like I said, a snowball effect, and one thing leads to the other. So a consistent, proactive interest rate cut is going to help us in the long run. Even if they're slightly off on some of the numbers, or maybe there's some hawkish things that happen, some bearish things, there's some fear in the market. 6 months to a year, it levels out and it becomes bullish anyway, maybe a year and a half. And I'm not saying this is all a fact, but based off of every single thing that history repeats and shows us, this is the data that we have. And a recession is highly unlikely at this point. None of the data supports a recession. The Feds no longer believe inflation is an issue, which is why they're aggressively cutting rates. We're going to get 50 more basis points by the end of the year, which is either going to come in one more 50 basis point cut or into 25 basis point cuts. And in 2025, they're going to cut another 100 basis points. So like I said, we're going to get 100 this year. We've already gotten 50, and next year is going to be another 100. So when you think about that, the Feds are aggressively cutting rates. And when you think about how interest rates work, if you don't understand, if you're cutting aggressively and you're increasing aggressively, that's good. But when you are in the middle, it doesn't really matter as much. Long term, it really doesn't matter. It's more about consistently and getting to where we need to go quickly and efficiently and proactively, which is exactly what the Feds are doing. So I'm going to give you guys a list of stocks that I believe are going to be really good between now and the election, or now and Christmas, and even further going on until the spring and the summer of next year. But it's going to have a lot of decent growth and stability between now and January. These are my top picks. However, first, if you guys are having trouble understanding all of this, and I mean, this can be very frustrating and hard to understanding the sentiment of the market, inflation data, news, stocks, technicals, fundamentals, it's all very difficult to understand. But if you are having trouble with it, I'm briefly just going to let you know that I offer a full training course, Discord, to surround yourself with like-minded traders where you can learn and grow together. And I offer full one-on-one coaching and masterclass boot camps to help teach you guys how to grow your financial freedom and get better and become profitable. It's a very serious mentorship, limited spots monthly. If you guys are taking your finances seriously and you want to grow, I would love to help you. You guys can sign up at investorcorey.com. Link is right there on the screen or in the information box below. I would love to help you guys. My students see a 15% gain in their first and second months, and they're up consistently month over month. If you guys want to get better and you want to grow your wealth and your financial freedom, I would love to help you. So let's look at the stocks that I recommend right now. We're going to go over a couple of them, and I'm going to show you guys exactly which ones I like the absolute most. So Tom Lee was talking about the financial sector. SoFi is going to grow pretty nicely. It's a small cap, and not only that, it's also in the financials. But they're not the only one. We also have Wells Fargo, which is a very strong investment, in my opinion, especially long term. This is another really good stock with a lot of growth potential. We have Bank of America, which is yet another great financial stock. In fact, this is my favorite financial stock right now besides SoFi. And we also have another one, Ally Financial. They have a very good dividend too, might I add, $30 per 100 shares, which is really good. They have a 3.5% yield, which is a little bit less than half or a little bit over half of Ford's dividend. Ford has the strongest one out of all the stocks that you can invest into right now, besides a couple of the unknown stocks that I wouldn't put my money into. And we also have Citibank, which is another great stock with a dividend yield of 3.41%, $56 on every 100 shares. This, like I said, yet again, another great financial stock. Now, there is another one, Synchrony Financial. They're also very good. And if you guys want to look at some other financial stocks that are not really, I guess you could say, pure finances, they're more fintechs, we can also look at PayPal. This is another good one. You can see it's running up. And we also have Square Block. This is a very good stock as well. And these are all really your best bets in the financial space. These are the stocks that I would look into, put my money into. And there are a couple other stocks in the financial space, but these really are the best ones. Now, if we're going to go ahead and look at retail, obviously, I would say Wayfair. They're launching physical stores for the first time. They have a lot of growth. They have low share float. Very good company. This stock has made me a lot of money, and my Discord members have made a ton. I got in here at like $40 and I got out right here around 50. So I made 1,000 every 100 shares and at 1,000 shares. So I made like $10,000 on Wayfair in a matter of like a week and a half. And I've done this like 3 times since January. So it's $30-something thousand, $40-something thousand over the last 7 months just in Wayfair. Great stock, but overall right now, because of the economy, it's down, but this is a good one to grab onto. Another stock that's really good is Walmart. I would put money in Walmart, especially now. Another really good stock that I would look into at this point in time would be TJ Maxx, TJX. This is a very good stock as well. Then we have Target. You could look into Target. Very good growth. Amazon is another really good stock for this particular point in time with uncertainty in the market. And you can also look at Alibaba. Alibaba is really good. A little bit riskier than, say, Amazon or the other stocks that I've shown you. But another stock that's really strong and has a ton of growth and not a lot of people talk about, Best Buy. Best Buy is doing really well. Their EPS is $1.34, $1.29, $2.72. Very good stock. Dividend of $94 on 100 shares, almost a 4% dividend yield, juicy premiums on the options, and overall, very good growth. I mean, the market cap is $20.89 billion. And we go into the financials. They have a yearly trailing 12-month revenue of $42 billion. So we divide $42 billion into $20.89 billion. We have a 0.5 price to sales. Like, that's insane. That's even better than SoFi's 0.94. That pretty much puts them on par for like a 50% gain every year. The 1-year target is probably $130. $105, I'm shocked. Like, their price to sales is 0.5. Apple's is 9. SoFi's is 0.94. Theirs is 0.5, which is crazy. If we divide the $1.34 into the stock price, they have a PE ratio, what, 70? Something like that? 60? Price to earnings, trailing 12 month is 16.98. That's insanely good. And their shares float is actually really good too. So good share float, good trailing 12 month on their price to earnings, good price to sales, good revenue, good EPS, and really good dividend, juicy premiums in the options. And they're in retail trade in the tech and electronics. This is pretty much, in my opinion, is as good just about as Amazon or Target or Walmart, and as good as Wayfair, as good as all of them, if maybe not even better. So we've covered these stocks. If we're looking at industrial stocks, we could look at Johnson & Johnson is really good. Caterpillar is a very solid stock. Colgate-Palmolive, very good. We can look at Costco is good. It's not industrial, but it's good. JB Hunt is okay. Not my top pick. There's Johnson & Johnson. Very good. Pharmaceuticals, health and technology. Kraft and Heinz, even though they're in consumer durables, they're still in a market that's very safe. Same as Coca-Cola. Nice dividends. We have ourselves like almost a 3% yield on dividends there. Kraft and Heinz, I believe, is almost 4. Yeah, 4.6%, 4.57. McCormick would be okay. Ultra Group is okay. Moderna is okay, but Payoneer's decent. Long-term financial hold. So Visa would also be okay for a financial stock, but these are pretty much the stocks that I would look at right now. I've given you guys a nice selection of stocks to take a look at, pick what you want, invest into, do your due diligence. I'm going to be doing videos on these stocks. And I also have a video coming out on the top stocks to buy in October, November. Some of these will be in there. And I'm going to do a couple of these videos because we're going to do top stocks for finances, top stocks for industrial, as well as top stocks for retail. This is not a time to be fearful. Right now, this is the time to make the right decisions, play the long game, the investor's game. When you're an investor, you win. And when you're a trader, sometimes you lose. And a lot of the time you'll lose as a trader if you don't understand the market and if you don't have a firm grasp on the sentiment, the psychology, like I've been telling you, and of course, the uncertainties, like the market does not like uncertainties. Right now, the best thing you can do is set yourself up for the long game, which is basically setting yourself up foolproof plan to succeed and not lose any money. Because let's face it, the number one rule of the market is don't lose any money. I don't believe we have a recession coming. I believe we might have a pullback due to the uncertainty around the election time, but we're going to dig ourselves in nice and firmly and safely and invest in stocks that have a lot of long-term growth, and we're going to set ourselves up for success. Guys, don't forget, webinar, free masterclass webinar this Monday, September 23rd, 8 p.m. Eastern Time, 5 p.m. Pacific. Limited spots. We are down to just a very limited amount of spots that remain. If you guys want to be on this webinar, you got to sign up. The link's in the information box below, and do it now because you're going to learn more in the 1 hour you spend with me than anywhere else. I have a huge announcement during the webinar, and I'll have a Q&A so I can answer any questions one-on-one that you may have had for me for quite some time. I hope to see you guys there. Thanks for being here on this video. We'll see you on the next one.